Okay, so welcome to another video. In this video, we're going to discuss some material that you'll find on Chapter 5. I'm going to teach you how to journalize purchases and sales when there's a purchase or sales discount involved. Purchase and sales discount is pretty much the same thing. The purchaser calls it a purchase discount and the seller calls it a sales discount. So I'm going to show you both sides to the entry. And the first one, we're going to see when the purchaser pays the discount, pays for the invoice on time, and so takes advantage of the discount. And in the second one, we're going to see a case where the purchaser does not pay the invoice within the 10 days, as you can see here, and therefore forfeits its discount, and we'll see how they book that, and also from the seller standpoint. We'll also do a little bit of we'll do a couple with freight, just so that you can see how the freight is booked, both shipping point and destination. Okay, so let's start off with the exercise and see what it says. It says, Hartwell Company manufactures automobile tires. On July 15, 2013, the company sold 1,000 tires to the Nixon Company for $50,000 each. The terms were 2, 10, and 30. That means 2% off if you pay within the first 10 days, 2% of the total price. If you do not pay within the first 10 days, then you have another extra 20 days for a total of 30 days in which you have to pay the full price, the $50,000. In other words, the first 10 days you get 2% off if as a purchaser you pay it, and from day 11 to day 30, in other words the next 20 days, you have to pay full price for the merchandise. So it says, prepare all related journal entries using the net method of accounting and under a perpetual inventory system. What does this mean? Well, net method of accounting for purchases and sales, that's the one that we're going to use throughout this chapter. That's the one that's going to be tested. There's another method that is, I don't believe it's even mentioned in the chapter, called the gross method. But that's not mentioned in the chapter, so we're not going to test that. However, just for your knowledge, you should know that there is another method in which you could choose to book these entries. And I'll explain a little bit about the difference between the net and the gross method as I go through the entries, okay? So prepare the journal entries to record the sale on July 15. Ignore cost of goods sold and collections. And ignore cost of goods sold, and collections were on July 23. So July 15 was the sale, July 23 was the payment. So the first question is, did they pay within the 10-day period? Does the purchaser pay within the 10-day period? The answer is yes. So the purchaser is going to get the 2% discount. So let's do our calculations here on the side. They purchase 1,000 tires, and then we're going to go ahead and multiply that by 50, and so they purchased $50,000 worth of merchandise, right? What's the applicable discount that they got? Well, it's going to be 2%, right? 0.02 times 50 is 1,000, so they got $1,000 discount. So their net payment will be equal to 50,000 minus 1 is 49,000. So that's what they pay. And since we're using the net method of accounting, the purchaser and the seller will both, let's assume both use the same method, the net method, will book 49,000 as an inventory cost, not the 50,000. The 50,000 would be used under the gross method, a different method which we will not explain. But the gross method will use the 50,000 as inventory, and then the 1,000 will be booked as a sales discount if it's taken. Under the net method, we just assume that the discount is going to be taken and the inventory is immediately booked with the discount included in it. So the purchaser is going to do an entry to increase their inventory by 49,000, right? That's what they received. Inventory is an asset, so it increases with a debit. Here I have the terminology merchandise inventory. That's what the book uses. Doesn't really matter if it's merchandise inventory or if I just put inventory. I might forget and just put inventory. Please don't worry. It's still correct. It's just terminology. Okay. So obviously they purchased on credit. So rather than cash, we're going to have an accounts payable here, right? So we're going to debit merchandise inventory and we're going to credit accounts payable. Let's see what the seller does. The seller is probably going to do the opposite. The seller is going to have an accounts receivable, right? For 49,000. And its inventory went down by 49,000. Right? So the inventory went down by 49,000 and I'm sorry, not inventory, sales revenue. We're going to ignore the cost of goods sold portion of this entry. This has two more entries, right? Where you're going to book cost of goods sold and offset that with inventory. But for now, let's ignore that. So the seller gets sales revenue of 49,000 and has an accounts receivable of 49,000. That's the correct entry. Okay. So then it's very simple. Once the merchandise is paid for, you satisfy your accounts payable if you're the purchaser. So I would imagine that we're going to have a debit here, closing the accounts payable, and you're going to pay with cash, right? So you're going to lower your cash as a purchaser. As a seller, you're going to receive cash, right? And you're going to close the accounts receivable because there's no longer an accounts receivable, okay? So that's quite simple, right? So what happens if the purchaser does not pay on time? Well, that makes it a little more interesting. The first entries are going to be pretty much the same because obviously both the purchaser and the seller do not know if you're going to pay on time or not. So we're simply going to go with the same entries. The purchaser does debits merchandise inventory because merchandise comes in, and accounts payable because they now must pay this amount. The seller does the same entry it did before. Accounts receivable because it now expects 49,000 to come into the store, and the sales revenue of 49,000. But here's where we have a difference. So what if they don't take advantage of the sales discount, the 2%, right? This $1,000. So how do we book that now? Well, if they pay later, like in this case, it says August 15th. So that's past the 10-day period. Let's see. I would imagine that they're still going to close their accounts payable, right? They're still going to close their accounts payable by 49,000 because they paid. They are going to record this $1,000 as interest expense. Why? Well, it's a charge that they incur for using 20 extra days. And usually when you are charged for time, that's strongly related with interest, right? Interest income and interest expense is the charge for the usage of money throughout time. So they're going to book the $1,000. You could call it a penalty. You could call it a discount forfeiture. But technically speaking, in accounting, we will call it interest expense. So it's $1,000 that they forfeit, right? And so now they must pay, and this entry here is wrong. They must pay $50,000. They must pay the full price, $50,000. So you see how the debits and the credits balance. And so I have to remember to save this because I had that entry wrong. So that's the entry if they don't pay on time. Let's see what happens with the seller if the purchaser doesn't pay on time. So we're going to have something very similar, right? I would assume that the seller is going to receive cash. How much cash they're going to receive? Well, they're going to receive $50,000 in cash, right? They are going to close their accounts receivable, which was $49,000 right here. And then that extra $1,000, you guessed it, it's going to be interest revenue, right? So for the seller, it becomes interest revenue. Why is it interest? Well, because the seller extended credit. They permitted the purchaser to use like $50,000 for 30 days, which didn't really belong to the purchaser, right? So at this point, now they're going to charge them. Now this is a pretty steep interest revenue amount. Most of the time, the purchaser will take advantage of the discount, and it's not going to let this happen. But if it does happen, these are the entries. Okay, so these are two scenarios that are presented in chapter 5, and so learn this because it will be in the test. Let's see another thing that they mention in chapter 5. One thing that they mention in chapter 5 is the free on board shipping point. Free on board shipping point and free on board destination. That's just the shipping expenses and who's going to pay them, right? So, and just you could get very confused with these terminologies. Free on board shipping point, the way that I look at it is, if it's free on board shipping point, that means that the seller, when the seller takes it to the shipping point, the seller doesn't have to pay. He puts it on free on board. So who pays then? Well, the purchaser will pay in that situation. And as we look through this problem, we see that freight costs were $250. Okay. So let's see how we handle that. In this case, free on board shipping point, seller takes it to the shipping point and doesn't have to pay. So the purchaser will pay the $250 shipping cost. So what's going to be the merchandise inventory amount? Well, let me not get ahead of myself, because you'll see how the merchandise inventory amount is going to include the $250 shipping expense. But in this case, they we'll book it separately, and it's sort of good because that way we can keep track of what shipping expenses were. So we'll do the normal entry separately. Merchandise inventory of $49,000 comes in, accounts payable of $49,000 comes in. But then you're going to do another additional entry to record the merchandise, the freight. And as you can see, this $250 in freight is what we say it's capitalized into the merchandise inventory, and accounts payable or cash, if you decide to pay for the freight cash, is $250. Now we could have easily combined these two and said merchandise inventory $49,250. Because this $250 will be allocated specifically to this inventory, and then have accounts payable of $49,250 as well. But this way you can truly see the two entries that were done, and that the purchaser will pay for the freight end costs. Okay, discounts are not applied to freight costs. So this exercise is continued the same way. The discount is going to was $1,000 on $50,000 inventory. So we did not calculate, when we calculated the discount, we did not calculate it based on $50,250. We calculated it based on $50,000. We do not include the $250 in the discount calculation. Okay. So let's see what the seller's entry would be here. Well, I'm assuming the seller's entry would be the same as what we had prior, right? Accounts receivable $49,000 and sales revenue $49,000. It's free on board shipping point, so the seller has nothing to do with the freight costs, and so there's no booking of freight costs here. Okay, now let's prepare the journal entries to record the purchase of sale on July 15. Include seller's cost of goods sold. So we want to include the cost of goods sold, the full entry. Now we're going to do, and assume freight costs were $250 and the terms were FOB destination. FOB destination means that it's free on board when it reaches destination. Well, if it's free on board when it reaches destination, it must be because somebody paid it at the shipping point. Who paid it? The seller paid it at the shipping point, right? So let's see how these entries are done. The purchases entries is probably going to be very similar. I'm guessing it's going to be only the top part because they no longer are involved with the freight costs. And let's go ahead and see. So yeah, for sure. Merchandise inventory, $49,000. Accounts payable, $49,000, and they don't have to worry about the freight. Okay, so what happens when the seller has to pay the freight? Well, we're going to have very similar entries here. We're going to have $49,000 as an accounts receivable, right? We're going to have sales revenue of $49,000, and then in this case, I'm going to show you the full accounting entry, journal entry, including the cost of goods sold, right? And cost of goods sold, they told me it was $40,000, as you can see up here. So cost of goods sold is an expense. We call it cost of merchandise sold in this book. So, you know, if you see cost of goods sold or cost of merchandise sold, it's the same thing. So please don't worry about that. Most books use the term cost of goods sold. This book uses the term cost of merchandise sold. So every once in a while I'm going to say cost of goods sold and write cost of merchandise sold. Don't worry, it's interchangeable. If I forget to put the word merchandise inventory and I only use the word inventory, it's the same thing, okay? So cost of merchandise sold is $40,000. That's going to be your expense, right? So if you notice here, 49 is the sales revenue, 40,000 is the expense. What's your gross profit on this sale? The gross profit is $9,000, right? 49,000 minus 40. And so in a multi-step income statement, you would see gross profit. You would book sales revenue of 49,000. Assuming this was the only transaction, of course, you're going to have various sales and various costs of goods sold. But you'll see the total sales revenue, and then you will see cost of merchandise sold, the total, and then the gross profit is the difference. And that's what's to be applied to selling and SG&A, selling and general administrative costs, right? So what's the offsetting entry here? Well, by now you should know that they've lowered inventory, right? So the inventory has gone down by $40,000. Okay, have we booked the freight yet? No, we have not. And so if you've noticed, we've gone past the 15 minutes mark. I got tired of being interrupted and being cut off abruptly, so I finally gave in and subscribed. And so now the videos might be a little longer, but the good thing is that we will no longer be cut off mid-sentence at the 50-minute point. But we're almost done. So this is the entire entry here for the sale, right? But we still have to book the freight costs. Okay, so what is the freight cost? How are we going to book this? Okay, let me look for. So we can, in this case, I guess I'm taking this from the PowerPoint slides. We named the GL account delivery expense. Now you can call it freight expense, you can call it, you know, as long as it makes sense, you know, the GL doesn't have one specific way to be called. In this case, we call it delivery expense. And then if the company paid it cash, it's cash, or if they still are going to pay the shipping company later, then it's accounts payable. But what you notice here, that they expense the freight cost separately from the cost of merchandise sold. Okay, so we do not include it together with the cost of merchandise sold. We show it separately. Cost of merchandise sold goes up here. In this case, for the purchaser, the freight cost tends to go and gets booked together with the merchandise inventory, right? So when the purchaser resells this inventory, well, they will indeed in a sense indirectly include freight costs, but that's the freight costs that they incurred when they purchased the merchandise, right? Because it's capitalized into the merchandise. So these are two entries, various entries that you need to learn from chapter 5, from the purchaser's perspective and from the seller's perspective. How do we account for purchase and sales discounts, and also a little bit about, free onboard shipping point. Who pays for it? If the terms are FOB shipping point or FOB destination, and how they're booked. Okay. Also learn a little bit about multi-step income statement, how they're presented. I spoke a little bit about that. One of the biggest differences is that in the multi-step income statement, you're going to show revenue and cost of merchandise pretty much in one section, along with the gross profit. And as I said, gross profit is simply what's left over. So if your revenue was 49 and your cost of merchandise sold was 40, your gross profit is going to be 9,000, and then underneath that you're going to have all the expenses that gross profit must cover, right? All the selling and administrative expenses and so forth and so on. Okay, so that's the end of this video, and I will continue to post videos as we go on through the semester. Thanks.